just we're running horrendous deficits. And the idea that we would just sort of double down on all of that without really taking into account the rest of the views of the world is, I think, a risky proposition for a country that requires about half of its debt to be financed by foreigners. Some people say, well, they're trapped. There's nothing the foreigners can really do, so they're going to have to keep this up. I'm not really of that mind. I think that, everybody has a choice. For now, the United States enjoys the most liquid markets in the world, deepest markets, especially in the Treasury market. But, things come and things go, and they are risking, I believe, the legitimacy of U.S. markets through these actions. It is time to admit that we were trying to sustain the unsustainable. We lived beyond our means for a while. As painful as it is to say, we might have to live below our means for a bit as we repair our balance sheets, or we risk our currency. I really don't see many other choices at this point.
Let's move on to another flashpoint, and that's what's going on in Europe. Everybody's been focused on Greece, Ireland, some of the other countries, or what we know as the pig countries, but what I have seen erupt here is a new crisis that's erupting in Italy. On the day you and I are speaking, bond spreads are widening on Italian 10-year notes, as well as Spain. In Greece, Chris, when you take a look at the overall European economy, is just basically a small part of, I forget what does it represent, 1 or 2%. But on the other hand, if problems begin to erupt in Italy, as we're now seeing almost a bank run on some of the Italian banks, Italy has the third largest economy in Europe. And if that starts to go into trouble, there's no way that this $440 billion rescue fund in Europe is going to be able to handle it. And then, you wonder who is going to be big enough in Europe to handle or bail out the rest of Europe. And the only one that's big enough at this point is Germany. And it's a question whether the Germans are going to be willing to do that.
From the readings I've been entertaining, that Germany's of two minds. On the one hand, you have the politicians attempting to do everything they can to rescue the banks and play that game. The people of Germany are very unhappy with the idea of bailing out Greece alone, but Italy for sure, and they should be. And so I think there's definitely some political pressure brewing there. If your listeners, anybody wants to really know what's going on over there, just grab yourself some charts of the banks of France, of Spain, of Portugal, of Italy, and just look at the charts, not just for the past week, but over the past 3 months, and you'll see everything you need to know about what's going on over there. This is starting to have shades of 2008 on it again. It's got some of the same whiffs for me, the same smells. Those would be the blowing out of the credit spreads and bond spreads, and we're looking at the very poor performance of financial stocks that and banks in particular that are exposed there. Watch for insurance companies to be following suit because they're exposed in some of the same ways. And this comes over the pond to the U.S. because there are a lot of U.S. banks that are on the other side of those credit default swap games they've been playing on the bonds that are in trouble over there. So that crisis is still developing. It's in no way contained. Fancy pronouncements from the ECB ministers aside, it's still developing. And the issue here is that if you just add up all the numbers, Jim, you put them all in a spot, it's not possible for Greece to grow its way out of its current conditions. And Italy's bonds are now higher than its nominal rate of GDP growth by a hefty measure. That's a mathematical flashpoint as well. It's trouble. And so the question is, when do we take the haircuts? When does that finally happen? And what happens when we finally get there? For now, everybody's trying to kick the can down the road a little further. And we've been doing that since 2008, and I hate to say it, all that's happened is that the stresses and pressures have actually grown worse, not better. We have, I think, larger issues right now that are going to be harder to deal with. And frankly, when another big market rout comes along, and one will, I think it's going to be that much harder for the rescue operations to be successful because people will be cynical. They will wonder if perhaps they ought not to have their money in the game at all. And that, in part, is what gold has been telling us since the beginning of July.
Let's move on to hard assets, in one in particular before we touch upon gold, and that is oil. Now, on the day you and I are speaking, the market is down. Oil prices on West Texas is down to about almost $87. Brent crude has fallen. The oil markets are down about $5 a barrel today with Brent at 107. Now, I have read some projections based on consumption and production with OPEC itself. It seems like it's been unable to increase its production. At the same time, it's consuming more of its own product, which means there's less available for the rest of the world that they can export to. Chris, you've seen all the pronouncements. OPEC will have a meeting. We're going to increase all this extra oil. Well, where is it? And if they could, why are we still dealing with triple-digit Brent crude? So that's one question. And number two is the mega projects that Chris Skrebowski did when he took a look at, okay, we've got depletion that is running at a much higher rate that we've been held to believe previously, and that's been confirmed by numerous studies, including the major study that the IEA did. And we get into this, what I call crisis window between 2012 and 2015, when the spare capacity within OPEC, meaning that the inability to increase supply when in comparison to demand, we could be running into supply crunches at a time when the Western countries and maybe even the global economy is not growing as fast. So let's talk about oil and get your take.
This is the story that often gets buried with all of the other excitement going on out there. So most people will look at the Dow and draw some conclusions from that. Oil is another market that I don't believe the Fed has a lot of control over, except that, when there's plenty of liquidity out there, it tends to drive up all prices. Oil, in part, is included in that. But oil is really special in the world economy. We all know that. And its demand is relatively inelastic to downturns. And we're in a position now where it's very, very clear there are warning signs all over the place that production is having real difficulty being sustained. There was just a marvelous article in Marketplace in the Wall Street Journal, I think 2 days ago, maybe 3, where they talked about all of the European oil majors had negative production figures for 2010. They had nice revenues, but their actual production was down. And it was the funniest thing to read because in every single case, according to this article I read, it was due to some specific sort of geopolitical event. There was unrest over here in Nigeria. Oh, wait, there was the BP disaster, so we had a little bit of a slowdown here. Everywhere they went in the world, they talked about some event did it, and they managed to make it all the way through the entire article without mentioning the fact that the main production fields for these companies that are not in trouble areas are all in decline. And so we're still at this point in this story where you can read an article like this in the Wall Street Journal and not hear about what is, I think, the seminal issue here, which is that the major fields are all 40, 50, 60 years old. They're creaky. They're starting to really slow down. New projects are not coming on nearly fast enough to make up for that decline. So what we're seeing is flat production at this point in time, at best declining production in many cases. And that's why I think even with the world's relatively weak economy, you've got Brent trading at over 107. Oil over 100 a barrel, 10 years ago, we would have thought that was preposterous, but here we are. And the thing that we have to really keep in mind is it's not whether the world produces 87 million barrels or 89 million a day. It's how many of those are available on the export market on any given day. And, as you note, a big trend, it's right there, anybody can look at it, is that in many of the countries that produce oil, they consume it, all of them consume it, and in most cases their internal demand is rising pretty sharply, 1%, 2%, 3% a year. At the same time, production is either flat or declining in some of those countries, Norway being a classic example, just a classic collapse of sea fields. And so that's really a dual exponential hitting your exports, right? Declining production by a few percent and then rising consumption by a few percent. Both of those are pinching in on your ability to export. And we're seeing that in country after country after country. And it's not unthinkable that we will hit an export difficulty well before we hit something that people will say, oh, well, that was, in the rearview mirror. That was the all-time peak. There it is. That was it. I think we're seeing the early stages of trouble already. And I don't know how the global economy survives on 100 a barrel oil, and I don't know how it'll survive on 200 a barrel oil, but it's coming. And so in big, giant, all interconnected thing here with debt markets and energy markets, but I really, really think people owe it to themselves. Keep your eye on the energy markets. It's really, that's where the game is going to be played out over the next few years.
Couldn't agree more, Chris. And I think it's almost sounds contrary to what we hear on let's say, the cable financial shows where, well, gosh, the economy is slowing down. There's going to be less demand for energy. They forget something about supply. They forget something called depletion, and they forget something called demand coming from the people that actually produce the stuff and 3 billion people on the other side of the planet. Finally, let's move on to the topic of gold. On the day, we've seen gold break down after hours, but on the Thursday that we were speaking, gold hit another record high. Your take on gold, because anytime we take out a new level, and it seems to occur in what I call $100 increments. When it hit $1,500, oh my goodness, we're in a bubble. It hit $1,600, we're in a bubble. It hits, every time it goes up $100, it becomes a bubble.
Gold is the world's biggest bubble. You know, it's been in a bubble since about $350, as far as I can tell from reading a lot of people. Gold is telling us something here. It's not a terribly big market. It correlates really well with a couple of things. One is negative real interest rates. That's always been gold positive. We're sitting with treasuries, short-term treasuries at 0%. Inflation is obviously higher than zero, so we have negative real rates, and I see those persisting for quite a while. So that's just kind of like a long, slow motor attached to the back of the gold boat. But the rocket that's attached to that boat is what's going on in the world central banks. So here we are on Thursday, August 4th. In the past 24 hours, 3 central banks have gone about trying to debase their currency or call it into question. The Swiss National Bank, the ECB stepping into the Italian bond auction, the Japanese bank going about trying to weaken the yen. And I think what gold's telling us is that there's every expectation out there that the Fed is going to follow suit. And really what we're talking about now is people saying, I am not comfortable really housing my money anywhere at this point. I'd rather have it sort of out of the game. And on that basis, you know, is gold in a bubble at $1,650? No. I could stop 100 people in Times Square, and if I found one that had gold or knew how to invest in gold or was savvy on what it was telling us, I'd be surprised. So we're not quite there yet, and all of the central bank actions at this point, and with my own personal belief that QE3 is a foregone conclusion, gold, what's a fair price for gold? Just we can start naming numbers. They're all silly from today's perspective, but when I first started buying gold, $1,650 would have been a silly number to talk about. So I'm truly in the camp that says until we see fundamentally that there is some willingness to engage in what I'll call monetary sanity on the basis of the world central banks and maybe fiscal authorities as well. So I'm just a believer in holding gold. And everything that I've been thinking about for the past few years has been confirmed. I've always thought that we would go down the money printing route because history said we would, and we have. And I've always thought that fiscal leadership would not be able to bite the bullet and do the right thing and really rein in spending, and that's absolutely been the case. Everything that history would say would happen has been happening. And so history is really clear on this subject. You really, really, really don't want to be holding an unbacked fiat currency during a time of such as the one we're in, when your fiscal and monetary authorities are unable to really look squarely at the predicament and make hard choices. So we're in the kick the can down the road stage. As long as that can keeps getting kicked, I'm a gold holder. And what's a number it could go to? Pick it. We're going to start talking about big round numbers, not in hundreds, but thousands soon, I think.
I couldn't agree more. Chris, as we close, you have put out a course a couple of years ago that you called the Crash Course. It was made available on a DVD from your site, but recently you have turned that course into a practical guide called the Crash Course. Tell our listeners about it and how they can get a copy.
Well, this is a book that's updated the Crash Course, which was completed just about a week and a half before the crash in October of 2008, so timing was fortuitous there. I'd been producing it for several months. And the book is the Crash Course, The Unsustainable Future of Our Economy, Energy, and the Environment. It's available at Amazon. You can go to my website at chrismartenson.com and click a link and get to it there as well. It's in most bookstores at this point in time. And, of course, you can get a Kindle version as well if you prefer that mode. And it's updated, and it talks a lot about why we're here, how we got here, and what the future probably going to look like. And I take my best guess at it and give people some practical advice on how to weather the storm.
And I just might point out, if you look in the FSN archives, you will find my interview with Chris on his book, The Crash Course. Once again, we've been speaking with Chris Martenson. He's the editor and proprietor of chrismartenson.com, and you can find his books at Amazon or on Chris's website. Chris, as always, thanks for joining us on the program.
Jim, it's been my pleasure.